Dominating coverage of this week's Federal Reserve meeting is whether it'll set the stage for a cut in interest rates in September, or perhaps even now. This focus, however, ignores profoundly the more important question: why in the world is the Fed manipulating interest rates in the first place? Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. It's just amazing. Just about everybody thinks it's the most normal thing in the world for the Federal Reserve to set interest rates. It's a financial version, however, of rent control, and most economists know that's ultimately a loser's game because it distorts and harms the real estate market. Interest rates are the price borrowers, in effect, pay to rent money. What the Fed and copycat central banks have been doing since the 2008-2009 financial crisis has distorted and damaged credit markets and harmed economic growth. Back then, the Fed went way beyond providing temporary liquidity to prevent the financial system from going into cardiac arrest. But instead of pulling back when the crisis abated, the Federal Reserve went on a binge of buying government bonds and packages of private mortgages with the express purpose of suppressing not only short-term rates, but also long ones as well. The Fed's holdings of securities ballooned from about $800 billion before the crisis to over $4 trillion. The era of zero interest rates had arrived, sending borrowing costs down to levels never seen before. The result was an orgy of borrowing by governments and certain parts of the private sector. Meanwhile, it perversely hurt the ability of small business to get credit for their operations. The COVID disaster fueled even more Fed buying of bonds. Today, the holdings of the Federal Reserve are over $7 trillion, down from the COVID peak, but still way too high. It was a prime reason for the outbreak of inflation. Today, global indebtedness is almost 3 times global GDP. Economic growth among most countries has been subpar since 2008-2009, which gets to the real question: why is the Fed still trying to control interest rates in the face of such a miserable record? The stock answer is to fight inflation by depressing the economy. But a vibrant economy does not cause monetary inflation. Reducing the value of the currency does, usually by creating too much of it. In the past, a central bank would raise short-term interest rates for the purpose of preserving the value of its currency, period. Influencing economic activity was left to government fiscal and regulatory policies. That began to change big time when in the early 1970s, President Nixon purposely devalued the dollar to artificially stimulate the economy in the run-up to the 1972 presidential election. Until 2008, the Federal Reserve would control the amount of bank reserves to try to affect economic activity. Since then, interest rate manipulation is its prime tool, particularly the rate it pays on bank reserves and money it borrows from money market funds, something that was not done before the financial crisis. We can only hope the next president undertakes a hard, searing look at how the Fed operates and the power it now wields before more and even greater damage is done. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions, and I look forward to being with you soon again.